On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi, team. Hope you're all well. Now that it's July and we're past the halfway point of the year, I thought it might be a good time to do a bit of a wrap of 2024 so far, and then to take a look ahead to the next 6 months and discuss how the outlook is shaping up, what investors should be expecting, and talk about all the things we need to be keeping an eye on. So let's do that, and let's start with the 6 months that was. It was a pretty lucrative first half of the year for investors. World shares rose 10.3%, which is a very good return over a 6-month period. We saw major indices in the US, UK, Europe, Japan, and Australia all hit new record highs over those first 6 months. The top performers were Japan and the US. Those two share markets performed best. However, when you factor in currency returns, things change. Returns from all of those markets that I mentioned, apart from Japan, are higher if you account for currency moves, and that's because the Kiwi dollar fell against most of those currencies apart from the Japanese yen. It was most weak against the US dollar and the British pound. So when you do factor in those currency moves, it's not the US and Japan that are the strongest. It's the US, emerging markets, and the United Kingdom, actually. And the returns from Japanese shares actually fall because the strong share market over there was offset by a weak Japanese yen. So that's international shares, a bit more locally, not quite so good. Local shares haven't fared as well as others around the world. The NZX 50 index slipped about 0.5% in the first half of the year. And rather than being at or near an all-time high, as is the case with the US, UK, Europe, Japan, and Australia, we're still almost 14% below our peak, which came in early 2021. And those of you that understand how the NZX 50 index is a gross index rather than a capital index, what that means is that the NZX 50 includes dividends, in contrast to the likes of the S&P 500 or the FTSE 100 in the UK. We include dividends, those other ones don't. So if you back dividends out of our main share market index, that gap between where we are now and that all-time high from early 2021 increases to closer to 20% rather than being just 14. So the local market has very much been a laggard, and that has continued into 2024. It hasn't just been the share market that's been lackluster. The housing market has been very subdued as well. House prices have actually fallen in the first 6 months of 2024, and that's after another soft year last year too. The housing market went sideways last year, and this year it's actually down slightly. So whether you've been in property or New Zealand shares, you haven't had great returns over the last 12 months, 18 months. Fixed income in New Zealand has performed a lot better. The NZX Investment Grade Corporate Bond Index has returned 1.8% in the first half of 2024. So that's nothing too dramatic, 1.8% return. However, at least it's in positive territory in contrast to New Zealand shares and New Zealand house prices. So you put all that together, and I still think it's been a pretty good environment for most investors in 2024. If you've had a diversified portfolio, you will have enjoyed quite solid returns so far. And to do that, you need to have had a healthy weighting to offshore assets. If you've been too concentrated in New Zealand fixed income, New Zealand shares, no exposure to those markets that have performed much better, such as the US, the UK, Europe, Australia, Japan, then you won't have done so well But if you have had your wealth and your share portfolio spread far and wide, you will have done fine, because even though your local investments will have headed sideways for the most part, some of those international ones will have done extremely well, and you've probably got a currency benefit on top of that. So that's the way the first 6 months of the year have developed. Looking ahead, as always, there is plenty to monitor. Interest rates are likely to be a key focus as inflation pressures continue to ease in most of the major regions. During the first 6 months of this year, we saw interest rate cuts for the first time this cycle from a few central banks, the European Central Bank, the Bank of Canada, and markets are expecting similar moves in the United States, the UK, and in New Zealand over the balance of this year. Provided economic activity holds together, this should make for a more encouraging backdrop for investors. Lower inflation and falling interest rates tend to be two key ingredients for positive returns. However, we need to keep a very close eye on the labour market, just in case unemployment rises more significantly than hoped. A bit of labour market slack has definitely been helping the inflation picture, both here in New Zealand and in the United States, but too much could push some economies into recession. Now, I wouldn't call that a base case, but it's definitely something we need to watch closely. The labour market is very important for not only the inflationary backdrop, but how the economy develops. Here in New Zealand, we're already facing some of those challenges. Businesses, consumers, both under pressure. Unemployment has been rising and quite quickly, plus house prices have fallen in 4 out of the past 6 months, and that has a big impact on confidence and on spending. Recent surveys have told us as much, whether it's the ANZ Business Outlook, whether it's the QSBO survey from the NZIER. Activity has been slumping on the negative side, but more positively, pricing intentions are showing an equally sharp decline. So while that's a little bit unpleasant, these conditions are necessary for the Reserve Bank to feel comfortable reducing the official cash rate, the OCR. We'll hear from the Reserve Bank of New Zealand on Wednesday afternoon next week. They've got a monetary policy decision due. You won't see a change in the OCR at that time, and we also won't get a new set of forecasts, but we will be looking for any signs of a change in tone. At the moment, economists at the big four banks don't see an OCR cut until early 2025. So ANZ, Westpac, BNZ, ASB, all picking first quarter of 2025. It's only the Kiwi Bank economics team out of the major local teams that are predicting a cut this side of Christmas. And I tend to agree with Kiwi Bank, and that's where the financial markets are at too. Financial markets see November as the time when an interest rate cut is assured here in New Zealand. So that could change as data changes, but that's where the banking teams are at, that's where I'm at, and that's where financial markets are at right now. That should give local shares a boost. I would think it will, even if the economic outlook remains quite fragile at that point. The share market is not the economy, after all. It doesn't mirror the economy particularly well. Many of our listed companies are large, stable, defensive businesses that should prove quite resilient through this period, and they do pay above average dividends that are quite sustainable. So the share market could still do okay, even though the economy is still in a difficult spot. Remember, the share market looks ahead 12 months, 18 months, or thereabouts. So the share market will be thinking ahead and responding to where it sees conditions going rather than where they are right now. Local fixed income could be a clearer beneficiary of that sort of environment. Levels of income have improved dramatically from a few years ago. You can lock in a yield of 5 to 6% for more than 3 years from exclusively investment grade securities with an average credit rating of pretty close to A minus or thereabout. That's offering conservative investors a good balance of risk and return. At an international level, politics will be in focus over the balance of this year. The US election is shaping up as the main event after plenty of action in the UK and Europe of late. And President Joe Biden's odds of winning have really crashed since that debate performance, which was very poor from Joe Biden. And the outcome of the election might now hinge on whether he's willing to step aside or not. More immediately, the US quarterly reporting season kicks off next week, and the high flying AI stocks, artificial intelligence stocks, will again be in focus. They've had a spectacular run, and investors are now grappling with high valuations while trying to figure out how long some of that stellar earnings growth from that part of the market and the market overall can continue. The US share market isn't as highly priced as it was during the COVID era of the very low interest rates or during the late 1990s and the early 2000s, but it is trading above its long term average. And analysts are expecting earnings growth of about 11% this year, accelerating to more than 14% in 2025, which is pretty good. And that's been driven in part, at least, by developments in AI. So time will tell if that's ambitious or not. For savvy investors, I think that performance gap between some of those market leaders and the rest could be starting to offer up quite attractive opportunities. If you look at the US market sector by sector, the technology sector and the communications sector, where Microsoft, Apple, Nvidia, Meta, and Alphabet, that's where they all reside in those two sectors. Those two sectors have both increased more than 25% each during the first 6 months of this year. And of the other 8 S&P 500 sectors, none of them have managed a double-digit return, and the average increase has been a much more modest 5.7% increase. To put all of that together, I think there's definitely some cause for optimism over the balance of the year, but it's mixed in with signs that we could be in for more volatility and that markets may not be quite as strong as we've seen in more recent history. From where I sit, there are still more reasons to stay invested rather than sit on the sidelines, as long as you cover your bases across asset classes, regions, sectors, and stocks. Hopefully that's useful. Thanks for listening, and we'll talk again soon.
For more insights, visit craigsip.com.